Welcome back, guys. I'm just giving you a little bit of a recap on some things that I have touched on in the past few videos. In this video, time is almost up at the Treasury. So in a sort of a pivot switch, I've been talking a lot about how federal monetary policy has been influencing our markets and economic dynamics today, in a kind of a twist. In the last few weeks, I've been saying that might shift more to the Treasury. And so with this chart here, I'm about to show you why. So this is the General Treasury Account. It's basically the checking account for our U.S. federal government. Now, ever since the 2008 crisis, the General Treasury Account has basically been moved to the Federal Reserve. Before that, it was deposited, I believe, in just major commercial banks, or with a certain major commercial bank, though which one I don't know off the top of my hand. But ever since 2008, it's just been deposited at the Fed, and I think it was done so to work in conjunction with the quantitative easing policy, so that way money can be moved around between excess reserves at the banks, which are also stocked away at the Fed, to be swapped out for Treasury bills, and then the money can be deposited at the General Treasury Account much more easily and smoothly. Now, in the past several months, we've been seeing a drawing down on the General Treasury Account. It first exploded upward with the initial passage of the stimulus bills in 2020, and it has been trending downward ever since then. So what that means is that essentially the government is spending more money than it's taking in, even through levying in more debt. It's been levying out less and less amounts of debt versus its expenditure programs because it borrowed such huge amounts up front here. Well, now, because the debt ceiling was reached around the end of July, the federal government has reached a kind of point where it can't really borrow any more money. It can only levy out debt to a certain ceiling threshold, and then after that, it's not allowed to issue out any more debt. It must operate purely based off tax revenue. Well, the tax revenue is coming in, but it's not enough to keep up with expenses, obviously, and we are now drawing down on that General Treasury Account. So now we've reached levels that have been the lowest since before the pandemic hit in 2020. So with this, as of September 1st, we've reached down to below the 300 billion threshold mark at the Treasury account. And as a matter of fact, it dropped even further when we take into account September 8th. Though why September 8th is not showing up right now, I don't really know. But it was showing up earlier. Maybe if I refresh it, it will pop back up. There it goes. So September 8th is shown up now. And so we're down to nearly $250 billion at the General Treasury account. Okay, so to give you a frame of reference here, let's take a look at what it was in 2019. So in 2019, well, this is probably in the wake of the repo crisis that hit in late 2019. We've seen that more or less the federal government kept maybe about $300 billion, maybe a little bit more on hand, stuck away at the General Treasury account. And this has been going on for, more or less the past 5 years. It's been about $300 billion. There's been times when they have drawn down, and then they have replenished, and so on and so forth. Well, now we're below that $300 billion. And although we're beginning to see a sort of slowing down in the drawdown of the accounts, I think that has to do with the fact that it's the end of the quarter, and so quarterly tax payments are being made. I'm not sure on that. Don't quote me on that. But that may be why we're seeing kind of a slowing down of the drawdown. But my guess is that, by the end of September, this is going to reach critical where Janet Yellen is going to be sounding the alarms and saying, hey, Congress, if you don't allow us to borrow more money, we're going to be in real trouble because the government might actually default on its debt since, oh, by the way, we're not running surpluses, we're not taking in tax revenue, and we've got hundreds of billions of dollars that we've got to come up with all of a sudden now to pay off these government bonds. and we're not allowed to roll over that debt and issue out new bonds to replace the old ones. We can't open up our new credit card at Chase to pay for our existing credit card at Wells Fargo, so to say, which is ridiculous that the government is so fiscally irresponsible, but we've really reached that kind of critical point. Now, if you've been listening to me, I've been saying how this should, key word here, should put downward pressure on the stock market. And a case in point here is to go back to the last time that we had a real fiscal crisis emerge from the debt ceiling debate, and that was in the summer of 2011. So when we go back to the summer of 2011, you can see here how there was just a little bit of a drop in stocks. Let me back up right quick. Here it is. You can see here how there was just a little bit of a drop in the stock market. Not much, but it was enough for the stocks to drop by, say, 5% or so. I think that, depending how long it takes for Congress to drag out, this could cause a short-term correction in the stock market. Another interesting thing to note here is that it was bullish for precious metals. So when we take a look at gold, and we go back to gold 10 years, when we take a look at what was going on in 2011, you can see how gold was peaking right here at the onset of the crisis. So with the debt ceiling debate being going on, gold was really starting to pop up and peak right around here to about $1,800 an ounce. Silver, of course, would peak around this time as well. And I think that has in no small portion having to do with that debt ceiling debate that was going on. Now it could be that things are this is just old news. We've been through this before. Congress is just going to argue it out to the last minute. Then they're going to pass it and everything just kind of blows over. Sort of like the Y2K. Beforehand, everybody's so worried about Y2K, but then after everything was adjusted, it turned out to be no big deal. So I'm not really saying for sure that this is going to be bullish for precious metals and bearish for stocks, but I do think it will be relatively. One thing to note, though, is that we're beginning to see a breakdown in that bull jump in precious metals, particularly in silver, not so much in gold yet, but because we're beginning to see that kind of breakdown here where silver is kind of underperforming where its previous lows have been, this kind of throws that monkey wrench into my mix that's saying, oh, wait, silver's price is going to continue to drive upward. Last few days, we've been seeing a drop here in the prices of the metal. And so that could be a whole host of factors. It could be that there is a flock to safe havens because, the Dow Jones has not been appreciating in price. It's been, kind of deteriorating, but the flock is actually the bonds, okay? So, we could be seeing a situation where government bonds, and I'll pull up the 10-year Treasury rate, may actually be seeing that interest rate fall and drop. It looks like, government bonds are kind of steady here. So there could be just a flight to cash itself. Let's see if we're seeing just a flight to cash itself here. I'll pull up the DXY chart and see what's going on there. This is just the dollar index. Yeah, so the dollar index is, relatively stable. So it looks like, markets are just trading sideways here. We're a little bit early. I'm a little bit early. We're not like down into like critical level. But one of the things that could be alarming here is that before it's like, okay, well we've traded down to about $150-200 billion in 1 month. What's the big deal? Well, the big deal has to do with this, and that's the federal deficit. So the federal deficit on an annualized basis of course, has been consistently negative for the past 20 years. Thank you, George W. Bush. Thank you, Barack Obama. Thank you, Donald Trump. And thank you, Joe Biden. But particularly in the last 10 years, we've been having huge amounts of deficits come through. Now, if you notice here, the deficits kind of repaired themselves during the secondary bull markets, how I'll call it, of 2014, 2015, 2016. So the fracking revolution kind of caused a mini boom in the economy, which of course resulted in more tax revenues to the government. But now with record deficit spending, this is becoming a problem because these record deficits are going to put more and more pressure on this General Treasury Account. And now look at what the deficit was in 2020. 2020's deficit was abysmal. It was $3.3 trillion of deficits. That's more than double what it was at the worst of the pandemic, or at the worst of the recession in 2008. Now, what's going on quarterly? Are we seeing a kind of improvement here? Not really. I mean, we're seeing a little bit, but if you look here, look at what's going on in quarter one. We had a 1.1 trillion. That was your Biden stimulus money. You know, we had a 500 billion, so we're already looking to have 3.3 trillion dollars. Quarter three is probably going to be another 500 billion. And, you know, where's that money going to come from? Well, it's got to come from somewhere. And right now, what's been drawing down of the Treasury account for the last month has been about $500 billion. Well, that's where your deficit is. So far, so good. But what about the next $500 billion? What happens if Joe Biden passes another stimulus bill? So on and so forth. So he's been trying to jam forth that new infrastructure bill. That extra $350 billion per month or $350 billion per year, it's got to come from somewhere. It's going to come out of the General Treasury. And like I said before, that Treasury account is not allowed to borrow. So I think that we're really going to see in the next week or so the debate really start over the debt ceiling. I would say to keep a watch on Janet Yellen. Keep an eye on Janet Yellen to see if she comes out in the spotlight, starts speaking about this, or starts using some type of lingo. Watch the news for her, because this should be the signal for it. The other person to keep a watch and an eye out for is Jerome Powell, but I would say that he would probably take a back seat to this more than a front seat. In Jerome Powell's views, he's going to be more concerned about the inflation numbers, which I'll go over in another video of what to expect for the inflation numbers that are going to come out early next week, and he's just going to keep a control over the aggregate economy. But yeah, definitely something to watch out for. It's going to have a short-term impact on the markets before leveling things out at some time in October. So keep an eye out for that. Guys, thank you for watching this video. If you like my content, make sure that you like this video. Click subscribe to hear more of my content, to watch other of my videos. You can view my channel. Click on those playlists and see what interests you. Leave a comment. Let me know what you think. Do you agree with me? Do you disagree? Are you not sure? Do you have questions? I'll be happy to answer and get back to you as soon as possible. And make sure you click that notification bell, because if you do click on that notification bell, then anytime I do upload a new video, you'll be able to be the first person to see it. So guys, once again, thank you for watching this, and I'll talk to you next time.